And fixed income, if you remember at the beginning of this, are the other major type of mutual funds. So now we're moving away from the old stock funds to fixed income, which are debt. They hold debt instruments. So let's just write down that as a separate topic. In those fixed income funds, you're going to find bonds, treasuries, and munis, and all those other types of things that we talked about in the bond video. And the goal of these is to generate a fixed return while preserving capital as best as they can. But remember that even these can go down depending on how risky they are in what they're holding. And so if you saw my bonds video, you know that the price for fixed income securities can also come down in rough market situations, or when companies default on their debts, for example. And just like equity funds, fixed income funds can be broken down into a 3x3 matrix. So let's draw that out. And in this case, on the axes, you have, on one side, you have sensitivity to interest rates. So let's say interest rate sensitivity. That also corresponds with duration, or the length of time that you're holding, that the length of the time that the bond is or the bonds are out for, and credit risk up here. And so let's say you have a low credit risk on this extreme, high credit risk on this extreme, and then on the interest rate sensitivity, you're going to have low sensitivity here and high sensitivity here, medium in the middle. And you could have fixed income funds that fit into any one of these different boxes within this 3x3. And as an example, U.S. Treasuries that are short-term will fit here, right? Because they are going to be low interest rate sensitivity, and they're going to be a very low credit risk. And then long-term junk bonds are going to fit into this other extreme because there's a long-term duration. There's a lot of interest rate sensitivity in holding a bond for a long term, and they're a high credit risk, right? So these funds can be classified in that way. And like I said, you can find medium credit risk with a low duration, and any one of these boxes. There's, again, dozens and dozens of different debt instrument funds to choose from, including funds that hold instruments like mortgage-backed securities that we talked about. And so those are typically called real estate investment trust funds, or REIT funds. And those will hold real estate securities to provide investors with some exposure to the real estate market without having to actually own buildings or properties, and without having to actually be loaning out their own money directly into the real estate mortgage sector. You can then expose yourself to that kind of investment using these REIT funds. Again, that's not for the typical investor. That's for somebody who wants to diversify into real estate that's already diversified across all kinds of different spaces. Of course, there are international funds that can fit into almost all of these categories that I mentioned as well. So far, all I talked about was domestic funds, but in the international space, you can find growth, value, debt securities, all these kinds of things. Just like they're available domestically, they're available internationally, and that would be another way to diversify, because you don't want to have all your eggs perhaps in one market. You don't want to have all your eggs in the U.S. market. You might want to have some money invested outside the U.S. market, as the U.S. market may go down and international markets may go up. And that can help counteract some downturns in some markets. Although there are times when all markets go down. Again, that's a risk that's always out there. And I think I've maybe just scratched the surface on the different fund types, because there's just seemingly an endless number of them and endless variety in the different kinds of funds you can find. And these mutual fund companies are always inventing more of them. So, this is just a general outline. but I did save what I think is the best for last, and that's index funds. And I kind of hinted at that earlier, and I'll just talk about that for this last portion. So index funds are funds that invest in market indexes. And market indexes are things like, you probably have heard these before, the S&P 500, the Russell 2000, the Wilshire 5000. And what these do is that they track the performance of an overall market. So the S&P 500 is a market of stocks that is the top 500 companies in the United States. The Russell 2000 is a basket of stocks that tracks smaller companies. So think of it maybe as a small cap index. And then the Wilshire 5000 tracks a broader range of companies, 5,000 of them. So people sometimes think of that as the broader market index. And again, what that is doing is tracking the overall performance of the entire market as opposed to tracking individual stocks. And so investors can actually invest in these entire market types of funds. Let's just talk about one as an example. If you invest in the S&P 500 index fund, you are putting your money into those top 500 companies in the United States, and your performance is going to track their performance. And you'll see that on S&P 500 charts. If you go again back to Morningstar and all these other places, you'll see that the S&P 500 has a performance over time. And the goal of these funds is to track that performance one-to-one. So if it goes up 10% in a given year, then your money should go up 10% by having invested in that fund. If it goes up 30%, your money should go up 30%. If it goes down 10, you should go down 10. That's basically the way it works. And of course, you can find market indexes for other stock markets around the world, like London, Tokyo, Hong Kong, etc. Now, because this is essentially a fixed set of stocks that are in these indices, the management of these funds is very simple. All they're doing is buying the stocks that correspond to the index. Because that's the case, there's called unmanaged funds, or funds that don't need a manager doing the work of picking stocks. And because that's the case, these are going to be very low cost. And that's important because cost in a fund could eat away at the overall performance, the overall return. So index funds tend to have very, very low cost, something in the like 0.01 to 0.05% range. And that can be a significant boost to your overall performance because money isn't being taken out by a large management fee from a managed fund. So some of these other funds that you'll run into will be run by a fund manager, and their job is to try to beat these indexes, right? If you have a growth fund that you are running as a managed fund and you're picking, the manager then has to be picking stocks to try to outperform the index. And the index that they usually try to outperform is the S&P 500 for a growth fund. So in their case, they're always trying to work hard to outsmart the market, trying to find those stocks that are going to do better than the average market and are going to perform better in the long run, or at least over the year that they're doing the work of picking stocks and selling and trading. Because they're doing all of that work, and it's not just a simple buy whatever is in the index like the index funds, they're going to charge a lot higher as far as their costs. So managed funds, again, this is a separate topic, right? This is not related to index funds, but managed funds will have higher costs. Sometimes as much as 5% or more, which is a big difference between that and an index fund. And that can eat away at your overall return, your overall performance. And the way to look at it is the following. If you had your money in an index fund that, let's say, returned 10% and had a 0.05% cost, and then you compare that to a managed fund that had a 12% return, but a cost of, let's say, 4%, then you see immediately that it's a better deal to have your money in the index fund because you almost got all your return. You got 10% minus that 0.05, so you got 9.95% return here, and here you only got 8%. So even though this manager is doing his best to try to pick stocks to outperform the market, okay, he outperformed the market by 2%, but the fees that he charges ate away at that and then some. And so in many cases, that's what happens is index funds are just more efficient when it comes to cost. The other thing that I mentioned earlier is the turnover. Turnover, again, we talked about, is what percentage of the portfolio is sold or turned over every year in that particular fund. For index funds, it's low because the stocks in the index don't change very often. The stocks don't change very often. You don't have to go and buy new stocks. You just buy the same stocks over and over again. Sometimes a stock gets out of whack as far as its performance. It does really, really well. And so that has to be sold in order to balance against all the other ones in the index. So they have some turnover, but they don't have a huge amount of turnover. We saw that one fund that we looked at earlier had about an 8% turnover. But for managed funds that charge that high fee again, their turnover is going to be much higher. In some cases, like 60%, I've seen some funds with turnover that high because the manager of that fund is constantly looking for new stocks to get into to try to beat the market, to try to get a better return. So they'll need to sell to gain the profits of the stocks that have already run up. And then they're going to have to buy new stocks with that cash. And they have to keep looking and looking. And so if they made a mistake and they thought a stock was going to go up and it goes down, they have to sell that and then go looking for another stock that's going to go up. And so they have to constantly be chasing and to try to beat that market performance. And what that does is affects taxes. The more that they sell on an annual basis, like within a year period, the more taxes that you're going to have to pay in that year. So an index fund that had an 8% turnover, you're going to have a low tax bill because you only pay taxes on the gains of these stocks or these mutual funds when when they're sold, when either the stock or the mutual fund is actually traded and sold and the money hits your account, the cash hits your account for that transaction. If the mutual fund is holding for a very long term, like 10, 20, 15, 20 years, whatever it might be, you don't pay taxes until those securities are sold or until you actually sell your mutual fund shares to get out. On a managed fund, if their turnover is 60%, you're going to have a much higher tax bill because you're going to pay every time there's a profit taken event within that particular year. And it's going to be what's called a short-term capital gain if it's sold within less than a year. Short-term capital gain, which is going to be taxed at your normal rate of tax. So if you're in a 35% tax bracket, you're going to be taxed 35% of that gain for that particular trade on that managed fund, as opposed to something like an index fund, which may be selling after a very long term. If they're selling after holding at least for a year, that's called a long-term gain. And that's going to be at the 15 or 20% tax rate usually 15. 20 is I think it's only if you're really, really, really rich and up there in your tax bracket. So it's a big difference again in what you're paying tax-wise from one fund to the other. And so as you can see, index funds are going to be a lot more efficient as far as the costs that you incur, as far as what you're paying for them, and also how they are treated when it comes time to pay taxes on the gains. And so you combine that together, the taxes you pay and the costs incurred, you're going to have find a managed fund that has a really big return as compared to the index fund for it to be worthwhile. And that's why I really prefer, if you haven't guessed it by now, I really prefer and like index funds over managed funds. Another reason is that long-term studies have shown that very, very few investment managers, very, very few mutual fund managers actually beat the indexes over the long haul. And now I'm talking there, 10, 15, 20 years and so on and so forth. Over the long term, it's very, very difficult for these guys to beat the overall market. And that's why a lot of smart investors choose index funds, because it's very hard to beat the market, and index funds will be lower cost and have fewer tax consequences. The overall goal of investing is compounded interest on your capital. And so if you can retain as much capital as possible by having lower expenses and paying less taxes over time, you're going to have more capital to compound as the years go by. And I should stress here that when you're investing in mutual funds, you should be thinking about it, again, in the very long-term horizon. It should be something that you're willing to put your money aside for 10, 15, 20 years or longer. If you have money that you've earmarked for investing and you think you want to use it in the next 5 to 10 years or less, then you're going to want to put it in something safer, maybe something like a US Treasury with a short-term duration, or maybe even keep it in cash if you're worried about even those going down in the short term. What you want to do is putting aside money that you're going to invest for the long haul and put that into a mutual fund or a group of mutual funds that best matches what your investment style is and what you and your investment advisor come to agreement on. This is not the same for individual stocks, in my opinion. A lot of people will say invest in the long term no matter what. That's true, I think, only for mutual funds. For individual stocks, that's not necessarily true, because not every company is a GE or a Tesla or an Apple. And even those companies aren't going to be perfect forever. They're not going to always be going up, and they're not going to always be growing. If you remember, Microsoft had its time when it was high flying and soaring, and then all of a sudden it came back down to earth and things got more normal. Even Apple in its history has been up and down, and it's been a darling of Wall Street, and it's been a very poor performer at times. So it's important for individual stocks to know when to get out and not necessarily hold them for the long term. And that's, again, why I think stock market index mutual funds are better than individual stocks, because it's much harder to tell which stocks to pick that are going to go up. And then it might be even harder to know when to sell them, because you might fall in love with a stock and hold on for it too long and then turn gains into losses. So again, disciplined investment says save money aside that you're not going to need for a very long time. Put it in mutual fund, put it probably in an index fund, and avoid individual stocks if you can. If you do invest in individual stocks, get out with profits when you can. Don't hold those for the long term just because you're holding for the long term. Have a good reason why you're holding for the long term on individual stocks. And once again, this is all general information. Consult your personal financial advisor before taking any action. That's what I had on mutual funds. And of course, it's a huge topic. I could go on for hours probably on this particular topic, but I'll leave it there. I think I covered the general basics. There's always questions that come up around exchange traded funds, or ETFs. When people talk about mutual funds, there's always the question, what about ETFs? Shouldn't we use ETFs rather than mutual funds? I'll cover that in another topic perhaps, but the short version is I prefer mutual funds because ETFs are traded intraday, and my whole stress on mutual funds is you want to hold them for the long term, and you don't want to have that temptation to trade a mutual fund during the middle of the day. If for some reason, let's say one day the stock market drops significantly and you know that your mutual fund is going to drop that day, you want to not think in terms of daily performance of a stock or a market. You want to think in terms of over the span of many, many years. And so a mutual fund helps you maintain that discipline of staying invested and doesn't give you the temptation that an ETF does of trading during the middle of the day. There's other pluses and minuses of ETFs that I can get into, but again, no time to cover that here, maybe in the next video. In a future video, I'll also discuss how investors can use index funds to diversify, whether they're starting out as a young investor or whether you've got several $100,000 that you want to invest as a kind of like in your 30s, or if you're approaching retirement and you're an older investor, and how you might want to diversify across both equity and fixed income type securities. Let me know if you have any questions or comments or any other video topics that you think I should cover. Thanks for watching and have a great day.